Mr. Sudhir Guntupalli. Thank you, and over to you, sir.
Good evening, ladies and gentlemen. Thanks for joining us today. On behalf of ICICI Securities, I would like to thank the management of Teamlease Services for giving us the opportunity to host this earnings call. On the call, we have with us Mr. Ashok Reddy, MD and CEO, Ms. Rituparna Chakrabarti, Executive Vice President, General Staffing, Mr. Sunil Chammankotti, Senior Vice President, Specialized Staffing, and Ms. Ramani Datti, Finance Controller. We'll start with brief opening remarks from the management and then open the floor for Q&A. Thanks, and over to you, Ashok.
Thank you, Sudhir. Just as the introduction, obviously we entered the year with the uncertainty of the pandemic on us, and I think we had an impact on the headcount. The whole aspect of industry lockdowns, the country lockdown, and everything else did put element of pressure on the headcounts and the open positions demand from customers, which kind of reflected in our Q1 with the overall headcount reductions. And I think from Q2 onwards, we have started seeing the opening up of the economy and some element of industrial activity starting to kick up. I think the most impacted in terms of the manufacturing, auto, and others to show earlier recovery on demand and open positions, which is reflected for us in our net app headcount growing or recovering from what they had lost by nearly 7,000. On the staffing front, some of the sectors still had an element of layoffs continuing into July and August, but from September we've seen an uptick on the demand and open positions and client onboarding, which effectively has resulted in about 500 growth in the associate count for the staffing business. The specialized staffing business, marginal loss in numbers, but in line with what we had earlier indicated, wanting to lose certain mandates and playing to a higher margin aspect on that front. So I think overall we are lower on revenues in line with the loss in headcount by about 10%, but the associate employee count has gone up by 4%, and overall the PBT and margin improvement has played out in line with the overall restructuring that we had gone in for. Obviously, in line with the expected drop in business and the uncertainty, we decided to take calls on our own internal employee count, our own internal costs, and also on whether we continue to exist in certain P&Ls. And one of that was the decision to close the firm business, an impact of which we have seen in Q1 and Q2 in terms of additional expenses that kind of have impacted EBITDA. But I think largely most of those expenses are now accounted for with some trail impact into Q3, but post that the firm business would be comprehensively sorted out. The institutional government training business that we intended to have a sunset clause on and not take any incremental business is also on track towards that, and we have not been able to kickstart the training programs even in Q2 with the government's insistence of it having to be physical rather than virtual instructor-led online programs. So I think the overall aspect of our restructuring has played out with internal headcount rationalization, cost rationalization, and also the profit per core employee improving by about 30% overall. I think the focus as we go forward will be to look at growing the customers, growing the number of customers. We believe Q3 and Q4 should be positive. Obviously, the festival demand is not going to be as large as in regular periods as in prior years. But we do believe that we should see positive demand and growth coming in Q3 and Q4. We would continue to focus internally on the team for productivity and performance. And I think overall, at a Teamlease perspective, we would continue to focus on growth, margin improvement, and capital efficiency. So I think that's largely what we would be driven on as we go forward. I'll have my colleague Ritu give a introduction or input on the staffing side. Sunil will give input on the specialized staffing side. Ravi, our CFO, will give a financial update, and then we can open up for questions. Ritu?
Thank you, Ashok. I think taking forward from what Ashok has already spoken about, I think the quarter remains by and large flat for us. However, there are some positive signs from some of our key metrics that we've been closely monitoring. I think for sure the productivity gains are visible. I think our FT improvement has been decent. I think we are at about 300 as against 283. So there are distinct productivity gains. Also, we are seeing, while July and August, we've continued to see losses or exits that have been happening across customers. However, from September onwards, we've been noticing distinct improvement in customer behavior and appetite to grow and hire. However, it is still sectoral and industry specific in nature. Just to give you a little bit of a color on that, I think we've seen about 43% of our overall customers during the second quarter. However, about 30% have been showing signs of some amount of growth, and the balance pretty much has remained as is status. We've also, in the month of September, I think, while we've added about 29 odd customers during the quarter, I think during the month of September, we've also managed to gain one large ticket customer. So I think we've been able to win back a large chunk of business from Samsung, from some of our peers in the space and leading staffing organizations, so to taking our share to a considerable number within Samsung's scheme of things. We've also seen hiring improving over the previous quarter. I think we've seen the overall overall contribution from hiring go up almost double. Of course, it's not so material, the growth, given that the previous quarter was quite low, but at least there are some green shoots in terms of hiring. So three key profiles that we are seeing hiring picking up is delivery agents, telecallers, and sales executives. And some of the sectors which are showing some signs of hiring include consumer goods, e-commerce, telecom, manufacturing, and a little bit in financial services as well. So also from a margin perspective, as against an expectation of general staffing closing at about 1.8%, we've been able to close at 2%. Also, yes, I think one of the interesting aspects that I missed covering in hiring is that a non-recruiter channel has contributed to almost 77% of the overall volume. I'll also take a bit of the opportunity to share with you a little bit on the labor codes. I know they have been talked about quite a bit in recent times, and given the time that we spent in this particular agenda, I thought I'll try and give you a compressed view. It's very compressed because we're talking about 400 pages of document across the 4 codes. The objective ahead of doing this reform process have been largely to take care of the challenges associated with having multiple laws, having multiple enforcement authorities, having multiple licenses, registrations, and returns, and multiple definitions. The core objective was how can we reduce the burden of compliances that silent employers struggle with and improve ease of doing business. So the first code is a wage code. That obviously got passed with Parliament about a year back, but it subsumed 4 of the old acts. I will just touch upon some of the key highlights that each of these codes brings in front of us. Essentially, the entire ambit of minimum wages, while it was earlier restricted to those in the organized sector and the formal sector, now there is an attempt to kind of cover all kinds of workers. Most of the transactions have been, the government is pushing for complete digitalization of the payment process, payment of salaries and wages. Contract labor is expected to be treated at par with any regular employees, and complete eradication of gender discrimination. On the social security, I think much talked about. It subsumes 9 acts, but the interesting one is gig workers have been included and defined. And there is an attempt to include all workers, organized unauthorized, under Social Security. OSH, which subsumed about 13 acts, I think it's of importance for the staffing industry per se, because the Contract Labor Regulation Abolition Act, Q2FY21, have been subsumed under this. And one of the agendas that we've been pursuing since 2011 of having national licensing, doing away with the fragmented approach towards licensing currently in practice, and which also leads to a lot of retail corruption, can be done away with, and also it helps eradicate a lot of mom and pop shops who are around as contract laborers. There is clear definition, responsibilities of principal employers, contractors, as well as workers. And of course, industrial relations, I think it subsumes 3 of the important ones. Besides provisions of changes around trade unions and their how they operate, I think the fact that fixed-term employment has been legitimized in all possible ways, and that the only difference, honestly, between permanent employees and fixed-term employees is the fact that fixed-term employees have an end date. Otherwise, everything else has to be at par. There's also the retrenchment process currently, where one needed to take approval from the government for anything above 100, now that limit has been stretched to 300. I think also there is an introduction of a reskilling fund, which is essentially to ease the process of retrenchment and termination. There is significant, the 29 acts of the 44 central acts have been reduced. However, the balance, which is almost 438, remains the state labor laws, which of course will be the next focus, or should be, of the reform agenda. But however, based on the ones that have been rationalized, we see significant gains for employers in terms of reduction of compliances across registration, returns, and registers. So while it's a beginning of the reform process, I think it's important to call out that one should not assume that this should immediately translate into business transforming overnight. I think the rules are yet to be notified, and I think it is just the beginning of the agenda. And I think in terms of the benefits of it, I think it should be into the long term. That's what we anticipate, but we don't think there will be some immediate changes besides the reduction of cost of compliance for much of the existing employers. I'll try and touch a little bit on the outlook for staffing. I think we feel that Q3 definitely have showing signs of there being an upbeat momentum in consumption. However, it is nothing still compared to the pre-COVID levels. So same quarter previous years would have been behaving differently. It's also very specific to certain organizations. So while we will see positive gains, but it's also important to not compare it with the previous quarter, because I don't think we will be hitting that level of growth and volumes, or quantum of hiring rather, to be more precise. PAPM, definitely we expect the average realization will come under pressure because pricing and cost of our considerations across all our customers. And however, it's important, that's why for us to continue our focus on improving our operating costs and the way we manage this business and improve productivity so that we are able to tide through the current situation. So that's about it from my side. Thank you.
I think the key variable on the labor code aspect is that, we have always said that any crisis is also an opportunity, and the government acting in these times to bring about legislative changes around ease of doing business and driving formalization in the long run will lead to the benefit of the industry overall. With that, Sunil will give an update on the specialized staffing side.
Thank you, Ashok and Ritu. Good evening. I trust you and your loved ones are doing well. We had a great quarter overall. Particularly from the sales front, we had bagged around 24 new logos, and together with these 24, we have bagged around 40 new customers in H1. These customers definitely have come at a much higher margin than what we earlier had. This is going to completely change the product mix in our system, and this is going to propel the growth in the coming quarters. The shared services which we kickstarted in Q4 last year actually played well, and we are seeing significant improvement in the productivity and cost savings. While overall the hiring activity remains subdued in Q2 across the IT and telecom sectors, our clients were majorly focused on aggressively bagging new digital transformation deals, which kind of transferred into new kind of requirements which we received, which were at a higher margin than the regular margins. So overall, if you see the kind of hiring we did in Q2 is at a much higher margin. The change in the skill sets and the change in the skill sets of our consultants which we deployed actually helped us to give a better performance. If you look at our overall PBT achievement in Q2, we moved from 7.7 last quarter to 8.2 this quarter with a margin expansion of close to 60 basis points. So that's a good jump what we achieved. Now the revenue remained flat. Particularly, we had a product change mix, so some of our low margin mandates which we let go were replaced by high margin mandates. So overall, I would sum it up saying that we had a better quarter compared to the last quarter in terms of the results.
Thank you.
Thank you.
Ravi will give an update on our side and then.
Good evening, everybody. Just a quick update on the financial matters. We began the year, not knowing how the year would actually pan out to be, but what we did focus on was management of balance sheet management, because we said we'll try and recover as much of our dues as possible. We'll try and control our costs, and we'll try and improve profitability. I think we've done reasonably well on all these fronts. Especially, our cash flow conversions have actually improved during the first half of the year, and we believe we would probably be able to continue the same trend going forward as well. Our DSO has actually come down from about 22 days overall for the company as a whole in Q1 to about 20 days. We also did get tax refunds for Teamlease and for a subsidiary Evolve during the quarter, during Q2, and this pertained to financial year 16-17. There are some more tax refunds that are due for the current year, which we will talk about later. We also did focus quite a bit on trying to see if we could get some of the litigative matters out, like we had a one-time settlement of an arbitration case, kind of close that out so that it doesn't niggle us going forward. We spent a fair amount of time on optimizing costs. As Ashok alluded to earlier, there was a lot of cost acceleration done on the headcount. we did get away from the permanent recruitment business, which led to a significant drop in headcount. In addition to that, there was a lot of resizing of teams that actually took place, consequent to work from home, etc. All these things have led to lower headcount and headcount-related costs. A large part of the benefits will probably start kicking in from Q3 onwards. We have also given up a fair amount of real estate space across the length and breadth of the country wherever we had offices, and those benefits also will start coming into play from kind of Q3 onwards. So by and large, I think overall we have done reasonably well on the cost front, although revenues were completely not under our control. All those which were under our control is something that we focused on, and I think it has given us the desired results. We still have a long way to go. We're still working on quite a few of them, and we hope to deliver on some of these between Q3 and Q4 and beyond that as well. Thank you.
Thanks, Ravi. I think, as Ravi stated, focus on cash flow, operating cash flow, tax refunds. We've been continuously getting those. We expect to receive some more in Q3 on the tax refund side. The focus on cost optimization and keeping the costs aligned to business volumes and focusing on productivity and technology implementation are key variables that we are focused on. Obviously, with the assumption that the worst of the pandemic is behind us, a key focus from all businesses is on sales, is on acquiring more customers and growing the existing customers, hiring for the open positions that are coming on board, and looking for growth in an aggressive manner, which is what we shall be focused on. So with that, Sudhir, we can open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudheer Guntupalli from ICICI Securities. Please go ahead.
Yeah, thanks. My first question is to Ashok. Our general staffing headcount in September 20 remained almost flattish on a sequential basis, and we are still almost 12% lower versus pre-COVID on headcount. Now that we have clarity and visibility on some more moving parts than earlier, what is the time frame you are looking at to reach pre-COVID kind of headcount, keeping in mind the seasonal factors, any supply side bottlenecks due to the non-availability of resources, so on and so forth?
So I think as we stated last time, and as we continue to work, we look to end the year with a higher number than we exited last year. So I think what we have lost, we would like to recoup and be larger than at the Q4 of last year. And I think, as Ritu stated, we are seeing opportunities towards that from the demand and the industries opening up on open positions. We are not betting too much on the seasonal aspect of the hiring and demand, because that is more for a shorter period of time, typically between 45 to 60 days. But I think what we are looking at is the demand that will be more sustained for the longer haul, that will carry the headcounts through as we go forward. So I think we would like to say that our internal aggression on sales is that we will end the year clearly with larger numbers than we entered the year.
Sure, Ashok. That's helpful. My second question is to Ritu. Thanks for those insightful comments on the labor codes. Does the new labor law paradigm treat the concept of part-time temp staffing any differently than the old? As in, does that bring in further legitimacy to the concept of part-time temp staffing? What would be Teamlease approach going forward on this area?
So based on the erstwhile legislation, part-time temp staffing was definitely possible even before, simply because minimum wages have been determined and classified across the 4 buckets of skill on an hourly basis. It's just that it's also a matter of appetite for youth to kind of opt for that, and I think as an industry, that's an option that has been exercised in bits and pieces. However, haven't seen dramatic success at scale. Having said that, the pandemic has also kind of opened up options and have also made it clear to job seekers and livelihood seekers that short-term work, part-time work, gig work is something that is sustainable and that can be an option for livelihood. So given that gig work also have been effectively legitimized in a big way, you will see emergence of alternative forms of employment and livelihood beyond just the traditional concept of permanent employees and having direct contract or contract employees. So there are different layers which are being legitimized and recognized by the government, and hence hopefully in the days to come would be added options for employers as well as job seekers.
Also, I think just to add to that, to the legitimacy to staffing existed. I think the regulatory complexity overall from a compliances perspective was quite large and has been from overall compliance perspective. And I think the whole Labor Code, Labor Act consolidation, simplification of compliances and all of that will benefit from the aspect of our cost to delivery and compliance activity. And secondly, it would also drive from a formalization at the corporate end, where, if things are simpler, are rationalized, are digitized, the need for formal employment and not playing below the radar becomes imperative as we go forward.
Sure, Ashok. So if I understand your comments and Ritu's comments correctly, you are essentially stating that this part-time temp staffing, the particular piece I was talking about, can actually become a big opportunity going forward. So in that case, I would like to, just know your thought process on how Teamlease will we be aggressively venturing into this area of part-time temp staffing or not?
So we cater to all customer demands and effective requirements. So as we go forward, through the tech platform that we have, through our channel partner and hiring network, the ability to deliver to customer requirements is something that we are building up on. As demand comes in on that front, we will work to deliver to that.
So we essentially, even at this point in time, like just a while back, Ashok mentioned and alluded to the fact that we are not getting carried away with the upbeatness that is now being talked about on festival hiring or festival-led. The reason is it's already we are noticing that a large number of employee supplementation have moved towards engaging part-time workers. Part-time by way of hours, part-time by way of the days in the week, part-time by way of being hired just for a season. So I think that's already at play. So whether it's hiring due to Onam, hiring due to Dussehra, hiring due to Diwali, we are noticing that trend already. Hence, from our perspective, we look at it as an opportunity to have some gains on the revenue front. However, on headcount, because of the fact, non-permanency or the fact that they are for limited duration, we are really not banking on that from that perspective.
Sure, that's very helpful. Last one from my side to Ravi. How should one think about margins going forward? Some aspects of the aggressive cost rationalization that you had undertaken may unwind going forward, like for instance, the salary cuts you had taken in the June quarter, so on and so forth, or real estate savings, so on and so forth. In that context, it will be helpful if you can give us some puts and takes on where you see the steady state EBITDA margins.
What we had, if you recollect, Sudhir, even way back in the month of April, May, when we had spoken to all of you, we had said that our focus for the current year, given that our performance for the year ending March 20 was not up to the expectations, we had said that our primary objective would be to take the margins back to FY19 levels, which was say about 2.1% by Q4, and that's what we would be focusing on in the immediate short term. And our long-term objective of taking margins to 3.5-4% continues to be on our radar, and that's what we are constantly working towards.
Sure. That's it from my side. Thanks and all the best to the team.
Also, sorry, just to add to that, the pay cuts that were impacted and the furloughs that were done have all been reversed effective Q2. So we don't carry that element of a cost benefit anymore. So the profit and the performance is inclusive of the fact that that has all been reversed and we are back to normal on that. The office costs and office spaces that have been given up, we will not be requiring, and we can continue with that cost reduction on a permanent basis.
Understood, Ashok. Thanks, and that's very helpful. All the best to the team.
Thank you. The next question is from the line of Rahul Ramswamy from Perfect Research Fund. Please go ahead.
Thank you for the opportunity. I have a few questions. I'll list them together, sir. Even in mature markets like the USA, the staffing industry is extremely fragmented. So can leaders here in India consolidate and gain market share? Next, what threats in India are we seeing from automation, reducing our long-term demand of workforce, as our global peers are not able to grow revenues, citing an automation issue? Finally, as per our channel checks, even large corporates are tying up with regional players. What advantage do we have against these regional players as they offer cheaper services than us? That's all.
So, staffing industry has always, if I look at it from a global aspect, there are about 8 to 10 large players. There's a huge missing middle, and then it's a highly fragmented market. And the same reality has played out in the Indian context also. So there are a few large players, missing middle, and highly fragmented market, primarily given that the entry barriers are low and it is easy to build an income-generating business out of this. But as and when you want to scale, investments are required, and that's where people tend to back off or get integrated into the larger players. Also, globally, staffing companies have played to a market that is 100% formal. So there's no informality, there's no structural challenge on formalized workforce, and a certain percentage of the workforce tends to get outsourced, and your opportunity to grow thereon is effectively a reflection of the economic growth that the country has and employment generation thereon. I think in the Indian context, we are far from being formal. We have a huge element of informal workforce, a huge element of informal outsourcing that happens, and hence the opportunity for growth for us is not just from the aspect of economic growth and GDP growth, but also an element of the formalization that needs to happen. So even if you look at the historical trend for the growth of the staffing industry, has always been higher than the GDP growth as a reflection of the overall employment generation that was happening, combined with a transition, a path transition, and a gradual transition from informal to formal. While automation and robotics and artificial intelligence and all of that will always play out with development of technology and otherwise, I think employment opportunities will also continue to parallelly evolve in different form and modes. And I think from that perspective, opportunity for growth for staffing is not going to die away. And from that perspective, we still believe that the headroom for growth is quite substantial. The headroom for formalization is quite substantial. And the opportunity for any staffing company will be high. We still believe the structure of the industry will play out as it is being globally. and that's really where at a point in time the consolidation can also be inorganic for growth for the larger players.
Okay.
I hope I've answered your questions, Rahul.
Yeah.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal Asset Management. Please go ahead.
Hi, good evening, everyone. Thank you for the call. I have two questions. Firstly, on the new labor code with OCU, any new clients that have come on board which may not have discussed with you earlier, but now is a reality because of the new labor code?
Too early, Susmit. The labor code has been notified. The rules are not even come into play. Like we said earlier, I don't think the labor code rollout and the rule issuance is going to lead to an immediate translation of market opportunity, but it's in the right direction, and that is really what we are looking forward to.
Got it. The second is just other HR services, right? And you mentioned that maybe Q3 we have a little bit more left. Is there a way that we can encircle the quantum that is still left to be recognized in the P&L?
Should not be more than 1 crore in that sense.
So this 4.6 crores this time would go down to 1 crore. Is that understanding right?
Yeah.
And the third is on pricing pressure, which Ritu alluded to. So I'm just wondering if the way you are pricing the contract is now changing as you're realizing higher FT productivity. So are you now able to price the contract lower because you have higher productivity and hence the same margin? And does that open up better or a bigger client universe?
So we do have the leeway because of productivity and cost rationalization at our end. But having said that, I think, we have across the 2 quarters maintained our average realization per associate per month, and we have not fallen on that. But I think what Ritu was coming in at is the fact that a number of customers coming in with the uncertainty of how the business is going to be and the aspect of support from a pricing perspective to see them through. While in Q1 we gave certain discounts, most of those discounts have been reversed. Q2 has very marginal discounts left over as a carry forward. But I think if certain mandates are there for the picking at a slightly lower realization than our current PAPM, we would be fine to take them now, given that a lot of the cost rationalization and productivity factors will offset that.
Correct. So you are open to that, and that.
Yeah.
Okay, got it. And one more question, one request. One question is that has there been reduction in competitive intensity that you have seen?
Can you just repeat that question, Susmit? Didn't hear you.
Any reduction in competitive intensity because there was a mushrooming of a large number of small players, backed by a lot of PE money. Has there been any reduction in that?
Small players really backed by PE money. I think the number of competitors in play is still the same, but in certain areas, I mean, not so much in general staffing, but in specialized staffing, the smaller players are challenged for working capital because the times are tough, the need to follow up and maintain your relationship and ability to get bank loans and stuff of that sort are limited. So I think the benefit for us is we are still debt free, we are cash flow positive, TDS refunds have put money in the bank, so all of those are good situations to be in. But per se, I don't think the competitive intensity has reduced. Some of the smaller players clearly are under working capital pressure and stuff of that sort, but that's the ups and downs that we get to see.
And lastly, one request, now that the tax refunds have started coming in, there's cash in the bank, from our experience, if you can put out a capital allocation policy that will be really forward-looking and helpful for us as an analyst community.
Yeah. So I think at this point in time, our outlook for utilizing the capital, the money that we are getting is primarily towards inorganic and acquisitive growth. There are certain opportunities that we are evaluating that complement our existing portfolio. We don't intend to get into any new lines of business. I think strategically what we've chosen to operate in will hold out for the coming periods. But clearly, given that there is stress in some of the smaller players, there are opportunities that we could roll up from either a specific team, clients, or complementary service offering that we could do. So I think at this point in time, we are looking at the capital as acquisition capital that we would like to use in the coming period.
Thank you. So Smith, we would request you to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi. Good evening, everyone. Had three quick ones. One is with the new labor codes, do you foresee any specific areas of the workforce seeing an upward reset in salaries due to the labor codes anytime soon?
So I think on paper, given that minimum wages now encompasses even those in the unorganized sector, so definitely on paper there is a possibility, but however, there is still questions on execution implementation. But otherwise, there is no other indication by which one can assume that because of the labor codes, wages could get affected or improved upon. Of course, like even for fixed-term contracts, whatever is the current norm for permanent employees, employers have to be consistent, so that could possibly be a scenario and an improved scenario. However, we'll have to watch this to see how much difference it makes to wages. One way of looking at it is that in the long run, if there is more formalization of workforce, how it impacts the per capita income in general. But it's really a long shot from now.
Sure. So you're not really seeing the labor departments come out and sort of try and enforce specific salary levels and things like this at this point, is what you're saying?
At this point of time, no. However, the central government has given itself powers to come out with 4 indicative zonal minimum wages. So if that comes into play, whenever it does, essentially across state governments, it's binding on them to have minimum wages at par with that or above. So at that point of time, we could see movement on wages. However, it will have its own set of consequences as well.
But also, listen, at this point in time, whatever are the minimum wage requirements and so on are adhered to by us. We just hope the government would enforce it on everybody else from a perspective of the informal lot that would then get formalized. But at this point in time, all the requirements from a wages and an enforcement perspective are taken care of by us.
Sure. The second one was, have you done any assessment in terms of how much the compliance cost could decline or come down by for your existing client set? And does this mean that the productivity per core employee could be much higher than what we had seen earlier?
So I think we have done a little bit of an assessment, not just for our customers, but in general for employers. So for example, on account of the rationalization that the wage code bill has made possible, we anticipate that the cost of compliance for return should go down by almost 57% because the activity is getting reduced to that extent. And similarly for registers, around the same benefit. On Social Security code, we see that on account of reduction of the number of registration, there is 75% gain. On returns, almost a 97% gain, because as against 36, they need to now file only one return. And on account of registers, also as against 20, they might have to do one or two, which is almost a 90% gain. The largest gain comes from the OSH, or the Occupational Safety, Health and Working Condition one, where across licenses, where the gain is 75%, registrations 90%, returns 95%, registers almost 95%. So the maximum load at this point of time is being reduced by the OSH, and industrial relations in any case doesn't have applicability of licenses, registrations, and the returns will just become one. So just to give you a little bit of a quantitative analysis of the gains that employers can anticipate.
And also just from our own core perspective, we have about 100 people in the team who take care of all the various statutory compliances for the activity that we do across the country and across customers. We clearly can improve productivity if things from a compliance perspective are reduced and are digitized.
Thank you. The next question is from the line of Nishant Karkera from Bay Capital Partners. Please go ahead.
Hi, I had a couple of questions. Firstly, I just wanted to understand the income tax assets a little bit better. So I think in March 20, we had about 245-250 crores of income tax assets on the balance sheet. Could you just give us rough numbers on how much of that has come back refunded in the past couple of quarters, and how much has gotten added to that base?
What we've actually got about 37 crores, including interest during Q2, and so that's the only refund that we've got in the current year. And it's probably and the balance amount is what has been added during the current year.
So we got 37, and maybe about 25 odd would have gotten added back, because I see just a 10 crore difference in that line item.
That's right. Yes.
Okay, understood. The second question is on the
30 crores in Q3.
Yeah.
Sorry, could you repeat that? I missed it. Sorry.
You should be getting another 30 odd crores in Q3.
Understood. Okay, that's helpful. The second question is on the hiring bit. I think Ritu made a comment that about 77% of the volume came from the non-recruiter channel. Could you elaborate? I couldn't understand what that means.
Sure. So essentially, or rather historically, a lot of our ability to close the open mandates or hiring mandates were dependent on recruiter headcount. So we have been consciously over the last few quarters attempting to move away from that model, which is besides the choke on productivity, I think it's a non-scalable model. We wanted to explore online channels. We wanted to explore vendor networks. We wanted to explore other sources like referrals and so on and so forth. So we have been able to consistently make an improvement, and as of now, 77% of the numbers that volumes that we are closing and adding are coming through non-recruiter-led channels. So,
Okay, understood. So recruiter channel is essentially where the employer himself or herself recruits and then onboards it onto your roles. Is that understanding correct?
No, essentially what we are saying is that if I am using my recruiter headcount, like our Teamlease own core employees,
Okay.
most of the hirings were happening through individuals, right? So now we have been consciously making an investment to leveraging, let's say, Teamlease.com, which is a key source of hiring for us, through referral networks, through vendor networks, through a lot of associations with the government and other partners, right? So our dependency on having recruiters to enable us to close positions is actually diminishing day by day, and we are seeing greater leverage to non-recruiter, which actually improves the productivity as well as helps us deliver scale.
I think just to add and clarify, recruiter hiring is effectively end-to-end activity done by an individual on finding a resource for an open position, whereas the vendor channel and alternate options that we have contribute to the hiring coordinated by the recruiter but not done end to end. So what it does is effectively, like we just mentioned, increases productivity, reduces our cost of hire, variabilizes our cost to some extent, and effectively gives us a larger reach for being able to deliver to positions without necessarily creating a fixed cost structure around it.
Thank you. Nishad, we would request you to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Nilay Prateek from Summer Capital. Please go ahead.
Thank you. My question is about the IT staffing business, maybe for Sunil. So first of all, I think it's a fantastic job that the team seems to have done on the IT staffing piece, where, despite the decline in revenues in H1, there's a substantial improvement in EBITDA. So I think Sunil alluded to a change in mix in terms of getting better quality business, and that apparently is leading to the improvement in margin. So if you can elaborate a little bit more on that, that's what I wanted to understand.
Sure. So what we have witnessed is that, in the Q2, the kind of requirements what we picked up, the new age requirements, which are digital engineering, cyber security, cloud adoption, etc., which were giving us a better return in terms of our margin and on our bill rate. So these got replaced with the low end business what we used to pick up earlier. So that's the change in the product mix.
Okay, but some of this essentially is, it's a completely different kind of skill sets that is required to deliver, business in these areas. And I think even in terms of the nature of the projects, they might be a little bit more on the, let's say, scope of work, ODC kind of side rather than pure play staffing. So how does that get taken care of?
With the acquisition of IMSI, which we did last quarter, we had a capacity or inbuilt capability to deliver to higher skill set, which is kind of, as you rightly said, it requires a different kind of capability that was built within our overall portfolio. So that's how we were able to deliver.
Okay, and just as a closing thing on this one, was there is the improvement in EBITDA almost completely attributed to this change in mix, or were there substantial cost reductions here as well?
It is a combination of product mix change as well as I explained, the shared services projects which we kickstarted in Q4 kind of started giving us benefits in this quarter. It gave some benefits in Q1 in terms of headcount optimization, but in Q2 we were able to witness the productivity improvement, and the shared services is catering to all the business units within specialized staffing. So that's kind of helping us to give better productivity. So it's a combination of both.
So just to give context to that, we have reduced headcounts as a year-on-year by nearly 150 resources at a core employee level.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal Asset Management. Please go ahead.
Hi, thanks for taking my question again. Wanted to check on the other income. Is there any write back of provisions, or it's just all treasury?
Hi, Susmit. So we have brought down our office space by almost 30%. So on account of that, there is the reversal of certain amortizations that we did on the rentals. So that is to the tune of about 3.7 crores. So that's the main component in other income.
Thank you. We would request the participants to please limit your questions to one per participant. The next question is from the line of Alok Deshpande from Edelweiss Financial Services. Please go ahead.
Yeah, hello, good evening, everyone. Couple of questions. Firstly, on the on the core employees. So as we can see from your presentation, the staffing core employee number has gone down from 830 to about 630. My question is, as we see a reversal in the headcount, going back to a pre-COVID level in a couple of quarters or probably 3 quarters, will we need to redeploy more core employees, or you think that this is the core employee number we'll be able to manage with?
So we would, from a service delivery perspective and a sales perspective, we would not need to add headcounts much. There'll be a marginal addition on that front. Also, this is on the back of a number of technology developments and rollouts that have happened over the last 9 months. So I think productivity from a service delivery perspective will stay on track. Some element as more open positions and demand comes in, we might hire on the hiring side. But other than that, we don't look to getting back to an 830 level even by the end of the year by any far chance.
Thank you. The next question is from the line of Kaushal Shah, an individual investor. Please go ahead.
Hi, thank you for the opportunity. So I had a couple of questions. Firstly, on the general staffing side, I want to understand that the associates which are employed by Teamlease, what percentage of those the search and recruitment effort as well as cost is incurred by Teamlease? Because my understanding from certain retail outlets in Mumbai is that these retail companies actually find and recruit the employees, and Teamlease is largely brought on for payroll processing. So would this be an exception, or can you broadly quantify what percentage of cases where Teamlease would have such an understanding? Also, can you quantify broadly? I understand that you can't give exact numbers, but what percentage of the associates receive some form of training before they're sent to the client location? This is on the general staffing side. Secondly, on the specialized staffing segment, if I look at the standalone financials of Teamlease Digital, the PBT losses have expanded for the third consecutive year. So can you explain what is happening here? Because this is a subsidiary where we have the two of the earliest acquisitions, which is ASAP Infosystems and Keystone, which were actually acquired in mid-2016. So can you explain directionally at an acquisition level what is going on the margin front? Thank you.
So on the staffing side, we have a combination. We don't do 100% of hiring for customers in general staffing. In specialized staffing, we do 100% of hiring as a function of the fact that customers are willing to pay for it. So the pricing model that we have is effectively a combination of recurring service fee for administrative aspects of keeping the employee transaction elements for lifecycle management, and there is a one-time cost for hiring. So customers have a choice around that, and rough estimate, and it will not be across the board, but about 30 to 40% of our customers require us to source. Others effectively say that I have the bandwidth to identify and track the resources. I will identify them and then pass them on to you to onboard and take it on from there. So that's really how we look at. So upfront, ideally, we'd like to source for all, but it's the customer's choice that comes onto the table. On training front also, in the NetApp side, which is our apprenticeship program, 100% of the apprentices get trained. We have a 200-hour program that's rolled out to them. Over and above that, we have additional training programs that are effectively choice for customers to take, which is similar in the staffing side. So we do what we call onboarding and induction training for all, but specific functional industry training is a choice for customers, and it is costed as an additional payable from their end. So that's really how we drive it. On the specialized staffing front?
Yes. So the difference in Teamlease Digital is on account of the goodwill amortization. So at Teamlease group level, at the consolidated level, while we don't amortize the goodwill and test it only for impairment at the end of every year in line with the Ind AS accounting. So Teamlease Digital as an entity is created by way of High Court demerger process with ASAP and Dishpro both put together. So as per the guidelines under that, we are amortizing the goodwill over a 10-year period. So that's the main difference that you can see as below line item, below EBITDA line, the other expenses in Teamlease Digital.
Thank you. Due to time constraints, that was the last question. I would now like to hand the conference over to the management for closing comments.
Thank you. So I think broadly we've been able to stem the losses that we had in Q1 on the headcount front and start to show a positive trend on the deployed base. We, basis the aspects of demand and customer feedback, do look to continue the trend of associate additions and effectively end the year better than we entered the year. And I think the continued focus on productivity, cost rationalization, and our core employee development is something that we will drive on while we look at the aspects of growth, cash flow management, and capital deployment towards acquisitions as we go forward. We do believe that the margin loss that we had last year, we will be able to recoup into this year as we move forward. So I think we are positive. Obviously, there are still many uncertainties around the pandemic and the COVID out there, but overall, I think we should look at a more positive aspect of growth as we go forward. Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.